Very good morning to all. Today we are going to see financial management, Unit 2, Part 1. It is capital structure. So, Unit 2 talks entirely about capital structure, how to make a good mix of debt and equity. Right? So, let us get into the session. Introduction. So, when you are making a financial plan, not only the capitalization is determined, but the nature and type of the capital is also decided. What is the nature and the type of the capital? That's what very important thing here. What is this nature and type of the capital? See, there are different types of capital: equity, share capital, preference share capital, debentures, loan. So, whenever you want to talk about capital, it talks about the long-term capital sources. Just to take your balance sheet, look at the liability side. These are all the long-term capital sources. Equity capital, preference capital, debentures, loans. That's all. But here we are going to talk about the mix of debt and equity, that is called a capital structure. In capital structure decision, it is determined which sources and how much finance should be raised. Under financial planning, we have already discussed the sources of finance and how much finance to be raised from the particular source. For example, I want 3 lakh rupees as my capital. So, what are all the sources I can raise my capital? Let us say 1 lakh from equity capital, 50,000 from debenture, and 1 lakh 50,000 from preference capital. See, this is an example. This is an example I can give. So, this is what we call as a capital structure. Thus, under capital structure, we determine the proportion in which capital should be raised from different securities. See, securities refers to equity, preference, debentures, whatsoever. Meaning, capital structure is the part of financial structure that represents long-term sources. Yes, as I said, in our liability side, it represents the long-term sources of funds. Okay, short-term source we call it as working capital. Like from where the money comes, short-term money. Bills payable, you can collect short-term. Creditors, you can collect short-term. So all those things. Right. So let us discuss further. In other words, it refers to the mix of long-term sources of funds such as debentures, long-term debt, preference share capital, equity share capital, including reserves and surplus, because reserves and surplus are properties of equity shareholders. Right? Reserves and surplus are properties of equity shareholders. So that is also taken into account. Okay. Management should determine the capital structure in such a manner that the cost of capital of the firm is minimum and the value to the shareholder is maximum. Across financial management, you see maximizing the shareholder value, definitely there will be a talk. And here, when you are determining this preference, equity, debt capital, debenture mix, you should ensure that you are going to pay a minimum cost of capital, not maximum. When you are paying maximum, that becomes expenditure. Okay, what is cost of capital? For equity capital, the cost of capital is, that is the minimum amount you are going to pay to the investor. For equity capital, it is dividend. For preference share capital, it is dividend. For debentures, it is interest. Okay. And for your long-term loans, it is interest. This you know very well. This interest and dividend is called cost of capital. That should be kept at minimum level. The value of the firm to shareholder is maximum and the market price of ordinary shares is maximum. It is correct. Whenever the share price is maximum, the value of the shareholder will also become maximum. Capital structure of the firm can have the following pattern. To acquire the funds only by issuing ordinary shares. Ordinary shares are otherwise called equity shares. Okay, only equity shares. That is one model. To acquire the funds by issuing only preference shares. Okay. To acquire the funds issuing equity preference and debentures. And try to understand equity shareholders are owners of the company. They are having the voting rights. But the dividend is not fixed for them. It is always a changing one. If there is anything left, if the board of directors decide to give dividend, equity shareholders will get dividends. But preference shareholders are just like your debenture holders. They will definitely get the agreed percentage of dividend, not more than that, not less than that. Relative ratio of securities can be determined by the process of capital gearing. On this basis, the companies are divided into two: highly geared companies and lowly geared companies. Highly geared companies, those companies whose proportion of equity capitalization is small. Low geared companies, those companies whose equity capital dominates total capitalization. Try to understand lowly geared companies are having a better survival, better ownership and control, because here equity capital dominates the entire capital structure. That is, equity capital forms a majority in that. Let us say there is a 5 lakh rupee entire capital. When we say equity capital is dominating, let us say the equity capital is more than 3 lakh or 4 lakh. Is that clear? Highly geared companies are losing their management control, the other way around, because their equity capitalization is small and the debt to capital grows. So what happens? The equity shareholders are losing their control on ownership. Understood? Nobody likes to lose their ownership and control. Try to understand. So whenever you are framing your capital structure, you should always have your own control on the capital. That is, the equity shareholders gets the grip. Okay, what is capital gearing ratio? Divides the shareholders' equity by the fixed cost bearing funds. The other way around, equity share capital divided by debt capital. It is called capital gearing ratio. Consider that always equity capital should be more, so the value should be more than 1. The output of your capital gearing ratio should be equal to 1 or more than 1. Common common stockholders equity is taken as equity less preferred stock. Here you should not include a preferred stockholder shares, only the equity stock divided by fixed cost bearing funds. Optimum capital structure. The optimum capital structure may be defined as that capital structure or combination of debt plus equity which leads to maximum value of the firm. Okay, how to maximize the value of the firm? By paying minimum cost of capital. How to fix up the minimum cost of capital? That is not a fixed one. Depends on the nature of the company, nature of the business, their position in the capital market, etc., etc. decides. Clear? Optimum capital structure may be defined as the capital structure or combination of debt and equity which leads to maximum value of 4. What is optimum? Optimum refers to maximum usage of something, that is called optimum. For example, optimum usage of taxi, what does it mean? Driver plus 3 or 4, that is the optimum capacity accommodation inside a cab. Like that, optimum capital structure refers to utilizing the entire capital at minimum cost. Clear? So this definition is given by M.I. Khan and P.K. Jain. Okay, qualities of sound capital structure. It is very important to understand What are the features or qualities of sound capital structure? So number one, safety, minimum risk, maximum return. So try to understand. These both are a reflection of the each other. Flexibility, minimum cost of capital, control, profitability, solvency, conservatism. Okay, safety. A capital structure should ensure safety of investment. It should be so determined that fluctuation in the earnings of the company do not have heavy strain on its financial structure. So your earnings should not have impact on the capital structure. That refers to safety. For example, if I get loss, the company which you invested goes on loss. It should not affect the equity and debt capital. Okay, if the company is already having some reserves and surplus, it will be able to manage and set off the loss. Otherwise, the safety is under threat. Your capital position will be disturbed. That means the company may go insolvent. Clear? So this is what we call as safety of investment or safety of funds invested. Okay, minimum risk. The capital structure should represent a balance between different types of ownership and debt securities. This is essential to reduce the risk and the use of debt capital. So always use the right debt capital to reduce the risk. Ensure the risk is minimum and return is maximum. Maximum returns. The financial structure of a company should be guided by clear-cut objective. So every company should be having a clear-cut objective in terms of their financial structure. Some company may say that there should be more debentures. Some company may say that there should be more equity. Some company says that go for a preferred stock. It depends on their own financial policies, which is backed up by the objectives. Its objective can be maximization of wealth of the shareholders or maximization of return to the shareholders. Either your shareholder sells of the shares, he should get a capital gain, or if he's holding the share, holding your equity shares, he should get dividends timely. That's what we talk about returns. Flexibility. A sound capital structure should facilitate expansion and contraction of funds. The company should be able to procure more capital in times of need, should be able to pay all its debts when it doesn't require funds. See, when there is a surplus in funds, the company is able to pay off the debts. When there is a deficit in funds, the company is able to procure the capital from the market. That's called flexibility. This flexibility is more in large cap companies. The company which has more than 20,000 crores as capital. And mid cap and small cap companies are having this opportunity quite lesser when compared to a large cap company. So big companies will have this opportunity. See, they will be able to pay off the loans because they are fundamentally very strong, or they will be able to raise the money when they need. This happens only with the large corporations. Small cap companies will be struggling with finance always. But in terms of growth, small cap companies grows better than a large cap company. Clear? Minimum cost of capital. That's what you need to ensure that you are paying the lesser interest or lesser dividend percentage. That you need to ensure. That is minimum cost of capital. For example, I get 10 crore of capital the source of equity, preference, and dependence. Let us say the overall cost of capital comes 15%. But the banker is my friend. He is ready to give me the same 10 crore rupees at 8% per annum. So which one should I go? 15% or 8%? So 8%, anybody would say this, right? But at the same time, I should not give space to dilution of ownership and control. So without disturbing the ownership and control of equity shareholders, I can go for a better loan so that I can say 7% per annum. If my company is a large cap or multi-cap company, I will be having crores as savings. Correct? Control. The capital structure of the company should not dilute the control of equity shareholders of the company. This is what we have explained in the previous point. So whatever the activities you do, that should not disturb the capital structure. That can disturb the capital structure, but should not disturb equity shareholder position in the firm. Anyway, if you are changing the mix or changing the ratio of the capital structure, that is debt and the equity, the capital structure is getting disturbed. But ensure that your equity shareholders, ownership and control are still the same. That's why convertible debenture should be issued with great caution. Okay, what is convertible debentures? After some periods, these debentures will be converted into shares or whatsoever the model which is described when it was sold. Clear? That is convertible debentures. Profitability. So whenever you fix up your capital structure, it should ensure more profits should be earned. It should offer the least cost of financing with maximum return. So it should ensure profitability. So that is input capital divided by output returns. Sorry, input capital plus, write it down so that you can understand the profitability. Simple formula: cash outflow divided by cash inflow. Cash outflow divided by cash inflow. What is inflow? Inflow is your investment. I invested 1 lakh rupees, for example. What is cash outflow? 1,50,000 rupees I got as a return. So what is the profitability ratio? 1.5, correct? Outflow divided by inflow. Is it clear? So your capital structure should ensure that the company can earn maximum profit by using this structure. Okay. Next one is solvency. Extensive debt threatens the solvency and credit rating of the company. The debt financing should be only to the extent that can be serviced fully and also be paid back. Okay. The company should be a solvent one to pay back its debt on time. See, the insolvent companies may not have funds or assets to service the liabilities. That's the position we call as the company is insolvent. You are approaching the legal help, right? So ensuring solvency at any time, that also matters. Conservatism. No company should exceed its debt capacity. As already explained, that is, the interest is to be paid on debt and the principal sum is to be paid. So what is the debt capacity? Interest plus principal. Because when you are increasing your debt, many companies says don't go for debt financing. We will go for equity financing because there is no compulsion for the company to pay the dividend on time. If the board of directors decides the dividend can be declared 100%, 50%, even 10%, remaining amount of the profit that is retained by the company for future purpose. But in terms of debt to capital, if you get a loan from bank, Whether you get a profit or loss, you should pay off the loan plus principal on time. So this affects your cash position. So companies are always having this conservatism. In terms of financial policies, they control the capacity to borrow. So in personal finance also at homes, you can look at your mother's or father's budget. They will say per month this has to be the total expenditure to be met. Beyond this, it should not go. So if there is any purchases, you should do it in the next month. Or if you are purchasing this amount on this month, next month it has to be cut off. So that is what in corporate level we call as conservatism. Either they get a good on credit and they will pay after 2 months, because the cost will not affect in the particular month, but the cost will be affected in the future. So always there is a ceiling. Your per month capacity, per month debt capacity. For example, every month the company is authorized to get, let us say, 5 crore loan from a particular bank as a cash credit. Right? That is a short-term loan. Company should not go beyond that at any cost. If the company goes beyond that without any planning, then it is losing its control. So one day or other day, it has to meet all the losses. Okay, in future, cash flows are not sufficient, then the cash insolvency can lead to legal insolvency. So those guys who have supplied you the finance, that is your preference shareholder, equity shareholder, debenture holder, your banker will file a case to get their amount back. Okay, factors affecting capital structure. Factors affecting capital structure: financial leverage, growth and stability of sales, cost of capital, risk, cash flow ability to service debt, nature and size of firm, control, flexibility, requirements of investors, capital market conditions, asset structure, purpose of financing, period of finance, cost of flotation, personal consideration, corporate tax rate, and legal requirements. We will see one by one in detail. Okay, financial leverage. The use of long-term fixed interest bearing debt and preference capital along with equity capital is called financial leverage or trade on equity. Both are same. Financial leverage or trade on equity refers to use of long-term fixed interest bearing debt, preference capital, and equity capital. So how we are using it, that's called leverage. The use of long-term debt increases, magnifies the earnings per share if the firm yields a return higher than the cost of debt. Definitely. For example, your return is, let us say, 25% per annum, and the cost of debt is 12%. So what is the difference? 13% is your earnings. So when you are using the long-term debt, it should magnify your earnings. That is, your return on investment should be more than the cost of debt. Clear? This is called financial leverage. Growth and stability of sales. The capital structure of the firm is highly influenced by the growth and stability of its sales. For example, if the sales of the firm are expected to remain fairly stable or it is increasing, it can considerably rise its debt level. For example, your sales is always increasing. Let us say you are in the growth stage of the market. Let us say you are in the growth stage of the market. So this month 1 crore sale, next month 3 crore, the next month it will be 7 crore. If it is increasing, accordingly your debt size will increase. So it affects the your capital structure. Because when you want to sell more, you have to produce more. When you want to produce more money has to be invested in raw materials, labor, and all those things. Right? In this way, this affects your capital structure. Cost of capital refers to the minimum return expected by its investors. Okay. You invest in ABC Limited, for example, equity capital you invested. And what is the cost of capital? What is the dividend you get? That is the cost of capital. You can expect, let us say, I need 6% cost of capital. Sometimes you are a banker and you invest in the company. You finance it to the particular company, ABC Limited again. Let us say 10 crore rupees. The banker says 11% interest. This 11% is your cost of capital. The capital structure should provide for the minimum cost of capital. The main sources of finance for a firm are equity, preference share, and the debt capital. That you know very well, right? Risk. Business risk refers to the variability of earnings before interest and taxes. Correct? The EBIT, earnings before interest and taxes, is not always the same. For every quarter, it changes, increase, decrease, and rarely stable. So this is due to internal and external causes. Let us say internal causes, you are increasing salary for your laborers. Okay, or sometimes internal causes, you are going for a new technology. So that will affect your earnings because you need to pay more for capital. External causes, let us say a political change or a legal change, will definitely affect your earnings. Correct? Financial risk refers to the risk of the firm that may not be able to cover its fixed financial cost. So financial risk happens when it is not able to cover its fixed financial cost. Financial risk is associated with the capital structure of the company. A company with no debt has no financial risk. So it's as simple as that. Financial risk refers to the company which is not able to pay its interest or principal or both to the financier, and the company is not able to pay back the bank loan, and the company is not able to pay back the debenture holder. This is where the place financial risk arises. Clear? The extent of financial risk depends on the leverage of firm's capital structure. The risk depends on the leverage of firm's capital structure. How much debt amount they borrowed, that matters. Cash flow ability to service a debt. A firm which shall be able to generate larger and stable cash flows can employ more debt in its capital structure as compared to the one which has unstable, lesser ability to generate cash flows. Let us assume that your customers, okay, your customers or your debtors or your bills receivable, these guys are financially very strong, so they pay you on time. So what happens? You are able to generate larger cash flow inside on time. Somebody pays before the date, majority of the client, for example, right? So in this case, you are able to employ more debt in capital structure because you are able to service those debt. Correct? But if you are not able to generate the cash flow on time, let us say all your customers, debtors, and your bills receivable category will not pay you on time, but they will pay, but not on time. So what happens? Your banker will not give you debt because your history is poor. Why your history is poor? Because of your debtors, your bill receivable, your customers are not paying you on time. So you are not paying anything to the banker on time. Correct? Debt financing implies burden of fixed charge due to the fixed payment of interest and the principal. So this is the reason when you are paying it, when your cash flow ability is more, you can get more debt, or it is less, you can get less debt. So this also affects your capital structure again. Nature and size of the firm. Nature and size of the firm also influence its capital structure. All public utility concern has different capital structure as compared to manufacturing one. You can look at different balance sheet. Let us take bank's balance sheet and let us take manufacturing balance sheet. Public limited companies will give it online and offline. It is mandatory. So you can go to any banks, you can get their financial. You go to any public limited company, you get their financial. Just analyze the capital structure, how much debt and how much equity. It is entirely different from a service company to a manufacturing company. Even within the manufacturing company, within the same field, for example, 3 companies manufacturing identical biscuits. If that is the case, also their capital structure will differ because their nature of the business and the size of the firm, their market share are entirely different. Correct? One may be a large cap, one mid cap, one small cap company. So again, their debt equity mix changes accordingly. Public utility concerns may employ more of debts because of the stability and regularity of their earnings. For example, public utility concerns, let us say transport corporation, or let us say electrical board, they use more debt instruments than the equity part because they have the stable earnings to pay 8% to 10% interest per annum. They're having stable earnings which will pay off the debt at 8 to 10% per annum. So majority of your debentures and large size bank loans will fall under this category. They will not charge more than 11% in most of the cases. On the other hand, a concern which cannot provide stable earnings due to the nature of its business will have to rely mainly on equity capital. That is there always. When the company is small, right? Or when our company is not having a stable and regular earnings, if that is the case, you must rely on equity capital because equity shareholders are owners of the company. They don't demand you the payment always. If there is anything left, you can spare them. Otherwise, you keep the amount as retained earnings. Control. Whenever additional funds are required by a firm, the management of the firm wants to raise the funds without any loss of control over the firm. This we have discussed in the previous topic also. So whenever you make any alteration in the capital structure, that should not affect the control of equity shareholders over the firm, because they should not lose their ownership and control. In case of funds are raised through issue of equity share, the control of existing shareholders will be diluted. So in this case, you try to sell the equity the new shares to the existing shareholders only. If that is the case, still their control over the organization is not diluted, rather it is getting more powerful. Hence, from the point of view of control, debt financing is recommended at any cost. The guy who has given the loan or the guy who purchased your debentures will not become the owner of the company. Correct? It is control. So depends on how you choose your source of fund, that affects your capital structure. Flexibility we discussed in the previous topic. Go back and see. Requirements of investors, because different types of investors require different types of returns. The requirement of investors is another factor that influences the capital structure of a firm. It is necessary to meet the requirements of both institutional as well as private investors when debt financing is used. Okay, institutional investor. A banker is an institutional investor, and many institutions are even subscribing your debentures. Let us say there are many mutual fund companies which is subscribing debentures of public limited companies. Okay, many private investors. Let us say every individual is a private investor. You invest in some company, you are a private investor. You are not an institutional, you are a private person. So you are buying their debenture. You became a private investor. So you should understand the requirement of investors while fixing the capital structure. Asset structure. Liquidity and the composition of assets should also be kept in mind while selecting the capital structure. If fixed assets constitute a major portion of total assets of the company, it may be possible for the company to raise more of long-term loans. But again, I should not conclude that fixed assets are always good. You should have the liquid assets always. When the money is sourced through a capital structure, when the fund is sourced through equity capital, preference capital, debentures, and loans, where it is invested, you get the money from asset side and deploy the same in the liabilities. Sorry, you get the money from liability side and deploy the same in the asset side. Is that clear? For example, I get 1 crore equity, 1 crore preference, and 1 crore debentures, 3 crores in the liability side. So what happens in the asset side? For example, asset side, let us say 1 crore cash, 1 crore buildings and machinery plants whatsoever, and 1 crore in the investments. Now it is clear how the amount are sourced in the liability side and used in the asset side. That is why we say liability and asset are equal always. So while deciding asset structure, keep in mind the composition of assets should not affect your capital structure. At any time, you should have liquid amount to pay off any losses, any expenditure whatsoever arises. That's why in the example also, I kept 1 crore in investment and 1 crore in cash. Okay. Purpose of financing. So for what purpose you are getting the finance? If funds are required for productive purpose, debt financing is suitable. And the company should issue debentures as interest can be paid out of the profit generated from the investments. For example, what is productive purpose? Productive purpose refers to the operations are done to multiply the funds. That is productive purpose. For example, you are going to produce something which is highly demanded in the market. Then the fund is taken for, or financing is taken for productive purpose. So whenever you are going to raise extra finance, it is always better to go for a debenture. Then period of finance. The period for which the finance are required is also an important factor to be kept in mind while selecting an appropriate capital mix. If the finances are required for a limited period, say 7 years, debenture should be preferred. Okay, if it is 20 years, equity shareholders preferred. If it is 10 years plus, you can go for a debenture or loan. If it is more than 10 years, definitely the equity market would help you. The period of finance, that matters when you are fixing up your capital structure. Okay, cost of flotation. What is cost of flotation? Although not very significant, a cost of flotation of various kinds of securities should also be considered while raising funds. The cost of floating a debt is generally less than cost of floating an equity, and hence it may persuade the management to raise debt financing. In case of floating of equity shares, you need to pay extra cost for floating it. What is flotation cost first, or cost of flotation? It refers to the commission amount or underwriting commission you pay to the merchant banker to raise the fund. For example, you cannot directly enter into the market and sell your shares when your company is very new. So what happens? Usually you go for a broker or merchant banker or underwriter, somebody else who take this activity for commission, right? If that is the case, equity shares, if they are selling, they demand you a certain commission. So in case of equity, the commission is more. In case of debt, the commission is less. So many management want to go for a debt financing, because let us say you want to raise 1,000 crore fund. Even a single percentage will result in crores of loss if you are selecting a different source of finance. Capital market conditions don't remain the same forever. Sometimes market may be in depression, sometimes it may be in boom. That will affect your capital structure. When the market is depressed, you should not issue for an IPO, or you should not go for an additional capital through shares. When the market is depressed, rather you can go for a banker or an institutional investor or a venture capitalist, or dependents could be okay. When the market is booming, you go for equity shares because everybody will purchase it. Clear? So this will affect your capital structure. If it is a depression market, you go for more debt. If it is a boom market, you go for more equity. Correct? Personal considerations. The personal consideration and the abilities of management will have final say on the capital structure. So every management is having a different experience on fixing their capital mix. So that decides the final say on the capital structure of the firm.